Hello, my name is Matthew Franz, and welcome to Business Analyst Reporting for Accountants. In this series, we're breaking down the skills accountants actually need to think like business analysts. Not just recording numbers, but using them to explain what's happening in a business and predict what might happen next. If you're studying for the CPA BAR exam, this content is built to help you connect the technical material to real-world decision-making. We'll cover topics like budgeting, forecasting, variance analysis, and performance reporting, and more importantly, how companies actually use these tools to run their operations. The goal here isn't to just help you pass the exam, it's to help you understand how accounting data turns into business insight. Let's get started. Today we're going to walk through how business analysts and finance teams turn raw financial data into decisions. This is heavily tested on the CPA BAR exam, and it's also exactly what companies expect you to do in real roles. We're going to look at financial statement analysis, cost behavior and decision making, budget versus actual performance, and how to turn numbers into business insights. I'll be using a sample company data set covering 1 year of operations. Topic 1, financial statement analysis. Trend plus profitability. If we start with revenue, we see it grows from about $120,000 in January to $230,000 in December. At first glance, that looks great. Revenue is almost doubling, but business analyst is about asking what happened underneath that growth. If we compare revenue to cost of goods sold, we can estimate gross profit trend. If cost of goods sold grows faster than revenue, margins shrink, which is a warning sign. For example, if revenue grows by 10%, but product costs grow 15%, that tells us either suppliers raised prices, production became inefficient, or the company is selling lower margin products. On the BAR exam, they love testing this idea, not just calculating margins, but explaining why they changed. Topic 2, cost behaviors, fixed versus variable thinking. Now let's think about operating expenses. Some costs change with activity, some don't. Variable costs move with units sold, fixed costs stay mostly stable short term. If sales drop but fixed costs stay the same, profit falls faster than revenue. That's why high fixed cost companies are riskier in downturns. In our data set, if units sold increase but operating expenses stay relatively stable, that suggests strong operating leverage, meaning profit will grow faster than sales. That's something management usually likes, but it also increases risks if sales fall. Topic 3, budget versus actual. So now look at the budget revenue and budget expenses compared to the actuals. If actual revenue beats budget, that sounds good, but we still ask why. Did sales volume increase? Did prices increase? Was it a seasonal demand? If expenses are higher, than the budget, that's not always bad. If revenue beats expectations by more, profit could still improve. BAR questions often test this idea. Good performance is not just hitting budget, it's improving profitability and cash flow. So let's turn data into business insight. Let's say we see revenue is rising, units are rising, but expenses are rising faster. The insight might be growth is happening, but efficiency is declining. The decision might be investigate labor productivity, negotiate supplier contracts, or adjust pricing strategy. This is what separates accountants from analysts. So, exam and career takeaway. On the bar exam and in real business analyst roles, always think in this order. What changed, why it changed, does it matter, and what should be done next. If you can do that, you're not just calculating numbers, you're driving decisions. So, what do we have here? We have gross profit, which is revenue minus cost of goods sold. And this shows the product level profitability trend. Looks like it's been going up. Gross margin is gross profit divided by revenue. And this shows efficiency, not just growth. Then we have revenue variance versus budget. And that's the actual revenue minus the budget revenue. And this shows sales performance signal. And then over here we got expenses variance versus the budget. Actual minus the budget. So we got actual, which is over here, minus the budget. And this signals cost control signals. So let's look at revenue against the budget revenue. We see that revenue is higher than the budget revenue, so that looks good. If the gap is widening upward, sales execution is strong. If the gap is shrinking, forecasts too aggressive or sales are slowing. Let's look at the gross margin. As you can see, if the margin is falling while revenue is rising, discounting or cost pressure. If margin is rising, pricing power or efficiency. When I compare actual revenue to budget revenue, I'm not just checking if we hit target, I'm asking why performance differed. If revenue beats budget, but expenses also rise, I need to see if profit still improved. Companies don't reward teams for hitting the budget. They reward them for improving profitability and cash flow. Revenue growth alone doesn't tell us if a company is healthy. If gross margin is declining while revenue is growing, that could mean the company is discounting products or facing supplier cost increases. That type of pattern is exactly what finance teams flag early. Thanks for watching this session of Business Analyst Reporting for Accountants. I hope you found it helpful in connecting accounting concepts to real-world business analysts. If you're studying for the CPA BAR exam, remember, understanding the why behind the numbers is just as important as knowing the rules. Keep practicing, reviewing, and applying these concepts. That's how you turn knowledge into insight. Don't forget to like, subscribe, and hit the notification bell so you don't miss future videos. And if you have any questions or topics you want me to cover, drop them in the comments. I'll make sure to get to them. Until next time, keep analyzing, keep learning, and stay curious.